Okay, first of all, so I'd like to thank the organizers for the invitation. So this paper develops a model with heterogeneous beliefs. So it has good quantitative properties on the joint dynamics of stock prices, trading volume, and the investor expectations. So I'd like to mention two expectations-related effects which discipline the modeling. So the first one is a positive correlation between the price-dividend ratio and the average return expectations, as in the previous Adam Masset and Buter paper. So in the model, this positive correlation is due to the so-called self-referential properties, namely the mutual influence of the equilibrium stock prices and the investors' price expectations. So the second fact is a positive correlation between the trended trading volume and the return expectation disagreement. So in the model, because disagreement is the only reason why the investors want to trade with each other, so the model generates a strong positive correlation between trading volume and the return expectation disagreement. So the paper then uses this model to study if a financial transaction tax can prevent the stock price booms. So the answer is no. In particular, the paper finds that stock price and the return volatilities increase with the level of financial transaction tax. So why is that? So firstly, stock market volatilities during boom times increase. So this is a pretty standard effect. So there's a new channel. So when the rise in normal time volatilities are coupled with investors' extravagant behavior, so the likelihood of boom bust increases. So this also contributes to the overall increase in stock market volatilities. So the paper focuses pretty much on the co-movement of disagreement about stock returns with the trading volume. So for a wider picture, I'm going to provide some complementary discussion on the co-movement of the disagreement with the price-dividend ratio. So I took this picture from Vincent Jorgensen 2003 MER Macroeconomic paper. So it shows investors' disagreement about the stock returns over the IT boom-bust cycle. So disagreement is measured by the cross-sectional standard deviation of 1 year expected stock return. So there are two time series here. So for robustness, so the line with circles, so that's disagreement among all investors. So the line with triangle is disagreement among wealthier investors with financial assets above $100,000 US. So what we can see from this picture is that the disagreement tended to increase during the price run-up, so that's before the year 2000, and the decrease during the price decline. So I would say there's a strongly positive correlation between the price-dividend ratio and the disagreement over this boom-bust cycle. So let's move on to the model. So I took this from Klaus' paper. So that's a boom-bust cycle simulated from the learning model. So the top panel is PD ratio. So the middle is stock investment, and the bottom is investors' return expectations. So I would say by and large, the model is consistent with the pattern I showed in the previous slide. So during the price run-up, so you can see expectations become more and more dispersed, which will drive up the disagreement. So during the initial phase of decline, say between period 30 to 40, you can see the expectations become less and less dispersed, which will drive down the disagreement. So yeah, there are a bit of consistency with the data. So during the later phase of decline, expectations become again more and more dispersed, which will drive up the disagreement. So I was curious to see to what extent the increase in overall stock market volatilities after introducing the taxes is due to the increase in normal time volatilities. So what's the relative contribution of increase in normal time volatilities, and what's the contribution of increase in the likelihood of boom bust episodes? So I did a little bit of accounting. So for example, this number here, so it says that the increase in normal time volatilities accounts for 60% of the increase in overall stock market volatilities after introducing the transaction taxes, the 1% transaction taxes. So it seems for the increase in PD volatilities after introducing the taxes, the increase in normal time volatilities play a dominant role, which is larger than 50%. So for the stock return volatilities, so the increase in normal time volatilities accounts for nearly half for 1% taxes and 2% taxes, and the dominant for 4% and 10% taxes. So then I look at a little bit on the composition of stock market volatilities. So the boom in the model seemed too big for me. So if you look at the statistics, so the conventional, so that's the mean PD ratio during boom times. So it's 424. So in the data, even the maximum 356 is far below the mean. So in relative terms, so the model also overstates the contribution of boom times to stock market volatilities. So here is decomposition. So this table shows the contribution of boom times to stock market volatilities. So use the data from 1949 to 2012. So for example, in the data, you can see that so the contribution of boom times to the volatility of stock returns is 18%. So while in the baseline model, so the contribution of boom times to the overall stock market volatilities is 58%. So there is a large overstatement of the contribution of boom times to stock return volatilities. And similarly, there's a substantial overstatement of the contribution of boom times to the PD volatilities. So my conjecture is that this computation may matter for by how much the likelihood of booms in the stock market volatilities will increase after introducing the taxes. So the paper is motivated by the recent introduction of the transaction taxes in countries like Italy and France. So the taxes in the two countries is 0.1% and 0.2%. So in the US, the number is 0.25%. And the model reports the results with taxes at the 1% or larger. So it seems to me the quantitative difference between the no-tax economy and the 1% tax model economy is small. So I just wonder for the countries with transaction taxes in the range from 0.1% to 0.25%. So are the taxes too small to have any significant effects? So there are a lot of empirical studies on the effects of financial transaction taxes. So these studies tend to find a positive volatility effect and a negative trading volume effect. So one we interpret, say, a positive volatility effect as opposed to this model. So I would say these studies neither direct support nor against this model. So if you look at these studies, so they just use very short sample, say 1 year or less before and after the change of the taxes. So the short sample is not a problem if agents have rational expectations. But if investors have imperfect knowledge, so these studies may only capture the short run or transition dynamics. When in the model, it make predictions about the long-run effects and also the rise in likelihood of boom bust, which would require much longer sample to test. However, it would be interesting to see if the transition dynamics of the learning model is consistent with evidence documented in the empirical studies. So a very nice paper. So I think that the paper is making an important step, building asset pricing models and analyzing financial transaction taxes disciplined by observed expectations. So it also uncovers some novel channel leading to rising volatilities in the trading volume with financial transaction taxes. Yeah, that's all. Thanks.